Hello, my name is Clive Corcoran and welcome to my YouTube channel, the Corcoran Codex. What I'm going to discuss in this video is how to risk manage the position as a seller of an FX option. Now, very often banks, commercial banks, are in that position where they sell options, especially for foreign exchange, to clients, and they thereby take on the risk that if the buyer of the option exercises and they have not properly managed and hedged their risk, they can end up potentially losing quite a lot of money. Now, the seller of an FX option contract has the obligation to perform in accordance with the contractual terms if the buyer exercises. So specifically, the seller of, let's say, a Euro USD call option should expect the buyer to exercise if the spot price rises above the strike price. So let's look at an example. Suppose a bank has sold a Euro USD call option, and it's a European style option, to a customer at a strike price of $1.10 for a notional amount of 1 million euros if the option is exercised. Now, if the spot rises to $1.20 at expiration, bear in mind this is a European style option, the customer will exercise by effectively paying $1.10 for the euros, because in the spot market they would cost $1.20. So given those inputs that I just mentioned, if the bank has not hedged its exposure, it will have to deliver to the customer 1 million euros and receive $1.1 million, i.e. the strike price that was agreed. But bearing in mind that the bank has not hedged its position, the bank would need to go into the spot market and buy the 1 million euros and pay $1.2 million for them. So this results in a loss to the bank of $100,000, less, of course, the premium that was paid by the customer on opening the position. Now, let's have a look at the diagram on the screen, which is essentially the payoff diagram for the seller of, in this case, a Euro USD call. So what we can see here is that the strike rate has been set at $1.10, and the premium or price of the option to the buyer was agreed at 200 pips. So if we look at the payoff diagram, we can see on the vertical scale we have the P&L for this particular option, and on the horizontal scale we have the exchange rate at maturity, and that, again, let us assume this is a European style option. Now, the thing to notice here is that the $1.10, which is the strike here, is here. And above that, we have this 200 pip benefit to the seller. The seller has earned the 200 pips by selling the option. As the exchange rate at maturity moves to the right, in other words, goes above the strike at $1.10, this then begins to introduce a risk to the seller. As we drop here, let's say, for example, down to spot 125, the seller is now down, after having taken into account the 200 pips here, is now down 50 pips. And the further that the exchange rate at maturity moves above the $1.10 here, the bigger the loss. As you can see, it's mounting. Now, supposing now at maturity the exchange rate has moved all the way to $1.25, we can see effectively that the loss to the seller would be $1,500, less the 200 pips that was earned as a result of collecting the premium. Now, in order for a seller, and typically that would be a bank, has been discussed, very often in the world of FX options, these are OTC, these are relationships between a buyer and, let's say, his or her bank. Given the risk to the seller, as is discussed, we now need to think about ways of managing that risk. And one of the main ways to do that is through a process known as dynamic delta hedging. The key principle for hedging the risk of being exercised is to maintain a delta neutral position with respect to the euros that may or may not be called. The bank should either buy or sell euros depending on the movements of the spot rate. Bear in mind, we have been talking about a European style option, so it effectively can only be exercised on expiration. But bear in mind that during the life of this option, the seller, the bank, let us say, is monitoring the movement of the exchange rate and has to anticipate the possibility, at least, that the option will be exercised. So what this amounts to is a constant recalculation of the delta during the life of this option, and then either buying more euros if the delta moves higher or the exchange rate moves higher, and selling if it moves lower. If the EUR-USD spot rate moves upwards, the bank should buy more euros. And if it moves down, they should sell euros. And this is why it's known as dynamic delta hedging, because it's an ongoing process making an adjustment to the overall position that the seller has, the bank has, on a day-to-day basis by adjusting the amount of euros that it holds in case, let's say, that the option ends up in the money and the client decides to exercise. At expiration, the bank will then have the required amount of euros based on this dynamic delta hedging exercise to deliver to the customer if exercised. And just as importantly, if, let's say, the customer does not exercise, the exchange rate is not above the strike, the bank would not want to be holding a certain amount of euros to deliver to the customer, because the customer will simply just walk away and write off the option. So let me now consider two ways of thinking about what I've just described. And this is now seen here in the Excel document. So we have, let's say, an at-the-money FX call option here, where the spot rate is at $1.10, and likewise the strike exchange rate is also at $1.10. Now we need then to price the option, and we need to use a modified version of the Black-Scholes formula, which allows for us to enter two interest rates, unlike, say, an option on an equity where there's only really a need for a single interest rate to be entered into the formula. We now need the two, so we need effectively a risk-free rate for the base, which in this case, of course, is the euro, and a risk-free rate for the quote currency, which in this case is the US dollar. Now, this is a 20-week option, 140 days. You can see what I've entered here. That's the fraction of the year corresponding to that. And we now need to look at both the Euribor or Euribor market and also the term SOFR market to find the appropriate rates to plug into this 140-day option. And I'm using the rates seen here. So we have a 2.75% for the risk-free rate on the euro and a 3.75% rate on the dollar. Now, the amount that the buyer of this option is able to gain on exercise is this notional here of 1 million euros. At the outset of this option, we have the spot rate at the same as the strike. We have calculated the delta here to 0.48. Notice this is quite close to 0.5, which is often the case for an at-the-money or 50 delta option. So now, in order to be delta neutral, the bank needs to hold 480,000 euros. In other words, that multiplied by that to be delta neutral. Now, let's say we move now to the second week, and we can see that the exchange rate has moved up slightly, and we recalculate the delta. It now comes to 0.51. This means that to be delta neutral, the bank must hold 510,000 euros, that multiplied by this notional amount here. So what now needs to happen is the bank needs to go and purchase more euros. And we can see what the dollar amount is that allows that additional amount of euros to be held. And we can see over here on the right, the overall hedge position of the bank. So we can work our way down here. We can see once again, there's a slight move up again. Delta's gone up. Bank needs more euros to be delta neutral. And we can see the cost of those in dollar terms. As we work our way down the 20 weeks, we can see at expiration down here, where the exchange rate is $1.17. Now, clearly, the customer will exercise. The option is effectively 7 cents above the strike rate. So clearly, the customer will exercise. And the good news is that the bank now has 1 million euros, holding 1 million euros, which it can then turn around and provide to the client when the client exercises. Now, as I indicated earlier, the other possible outcome, of course, is that after 20 weeks, the exchange rate is actually below the strike. The customer will not exercise. It'd be cheaper to go into the spot market and buy at 1.09 rather than pay the $1.10 on the strike. And the good news from the bank's point of view is that as a result of the dynamic adjustment to the size of the holdings of euros based on the changing delta that we've already discussed, the bank now would not have any euros set aside for the client because the client is not going to exercise. Well, I hope very much that you found that video to be of interest and valuable. And could I suggest that you subscribe to my channel, the Corcoran Codex, where the theme is analyzing critical ideas and episodes in the world of global finance. If you do subscribe, then you will be notified as to when I add new material to the channel, which I do on a regular basis. Thank you very much for watching.